a better alternative to FD, offers higher returns without the roller coaster of the stock market. That's the tagline of many online bond platforms these days. Bond investment platforms like Giraffe are promising curated fixed income opportunities that appear to strike a balance between risk and reward. Listed corporate bonds, government securities, high yield debt, it all sounds sophisticated. And now, with just a few clicks, retail investors can access these once exclusive instruments. But is it really that simple? Can higher returns be delivered without hidden trade offs? What happens if one of these carefully vetted instruments defaults? And how much can you rely on the platform itself to navigate credit risk? These are important questions, especially when the promise sounds just a little too good. So, in this video, we will take a closer look at how Giraffe works, what it offers, and the risk that we don't always get top billing. And more importantly, we will help you decide, is this a smart move for your money or a step too far outside the comfort zone. So hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So let us first understand the bond market. Have you ever lent money to your friend and expected it back with the interest? That's essentially what a bond is, but at a formal level. Bonds allow governments and companies to borrow money from the public, promising to repay with interest. But what makes that market tick? Why is the bond market called the backbone of the economy? And if it's so important, why don't more retail investors participate? The answer is simple. Lack of access, awareness, and ease of investing have historically kept retail investors away. Platforms like Giraffe are now trying to bridge this gap. So, what is a bond? At its core, bond is a loan made by an investor to a borrower. The borrower agrees to pay back the principal along with periodic interest. Simple, right? But what if the borrower defaults? How do bond prices change with interest rate? Can you sell a bond before maturity? And if so, how easy is it? These questions show why understanding a bond's terms, ratings, and liquidity is essential before investing. And next up, we have government bonds. So think of these as the gold standard of debt investments in India issued by the government of India. They offer unmatched safety, but can they beat inflation? How easily can you liquidate them? Is the process user-friendly for retail investors? Are there any hidden cost or liquidity traps? While G-Secs provide safety, they may fall short on liquidity and returns, making them ideal for conservative investors. So the minimum investment amount is 1000 rupees in multiples, and you can invest through RBI Retail Direct portal. And why were corporate bonds out of reach for so long? Because of high entry barriers. But now with SEBI lowering the minimum to 10,000 rupees, retail investors have new opportunities. Still, key questions remains. How do you judge which corporate bond is trustworthy? Should you only go for AAA rated ones? Do higher yields always mean higher risk? And how do you check a company's fundamentals or debt servicing history? Corporate bonds offer attractive yields but demand careful research and risk assessment. Would you lend your money to someone without knowing their repayment capacity? Probably not. That's where credit ratings come in. But how reliable are these ratings? Have there been defaults even among high-rated instruments? Should a downgrade worry you? And can a single rating capture a company's true financial health? Credit ratings are a useful starting point, but they are not the whole picture. Look at cash flows, business fundamentals, and industry trends. Now, here's a quick list of the major players as the top credit rating agencies in India presented on the screen for you. But do they all rate bonds the same way? And how often do they update their ratings? And could conflicts of interest arise since issuers pay for ratings? Check ratings across agencies and stay updated, especially in volatile markets. So we do have a small tabular column presenting a simplified rating scale for your reference, which you can pause and see. Now, let us take a look at types of bonds based on collateral, because you see, not all debt is created equal. Bonds vary in safety depending on what backs them. So senior secured bonds are backed by collateral, so that's the safest. Senior unsecured bonds have no collateral, meaning it has higher risk. Subordinated bonds are repaid only after senior bonds, so it has higher risk. And perpetual bonds have no maturity, meaning it has the highest risk. So if the issuer goes bankrupt, who gets paid first? Can you recover anything? And does collateral actually offer real protection? For conservative investors, prioritizing secured over unsecured debt is often wise. Now, let us take a look at the Giraffe platforms. The overview. So Giraffe operates under SEBI's online bond platform provider framework, a regulatory label that may offer comfort, but what does it actually mean for you as an investor? Ask yourself, does SEBI's oversight mean the platform is completely safe, or does it simply ensure a basic level of regulatory compliance? How well does Giraffe disclose the inherent risk of each investment? Can you rely solely on its filters to guide your investment decisions? While SEBI's framework offers protection against fraud, it does not eliminate default risk. That responsibility still falls on the investor. Your own due diligence is critical. So Giraffe offers carefully curated fixed income investments with thorough risk assessments, and investment options are clearly categorized by risk levels for informed decisions. And there are high yield bonds delivering returns up to 14% and fixed deposits offering competitive returns up to 9.10%, which is subject to availability. Giraffe also provides access to listed corporate bonds, sovereign gold bonds, treasury bills, government securities, and state development loans, securitized debt instruments, and fixed deposits. So, interest is typically paid monthly, quarterly, or semi annually. But the structure raises important questions. Are you sacrificing the power of compounding by taking regular payouts? Will you reinvest these payments to maximize returns or leave them idle? Would a growth option like those offered in mutual funds be more tax efficient? What if the issuing company faces liquidity issues? Will payouts continue? Reinvestment discipline is crucial if you're aiming for long-term wealth creation. Periodic income sounds attractive but may fall short for compounding focused investors. So what are the minimum investment details on the Giraffe platform? For bonds, the minimum amount is 1000 rupees, the minimum tenure is for 7 months, and the payout frequency is at least monthly. And for fixed deposits, currently no FD options are available on the platform. And before you invest, ask yourself, are these minimum amounts in line with your financial goals and cash flow needs? How much of your overall portfolio should you realistically allocate to these investments? Is this the right place to park your emergency fund? Probably not. While small ticket sizes make bond investing accessible, it's crucial to ensure they fit well within your broader financial strategy. Are you ready to integrate these thoughtfully? So let us take a look at the Giraffe's platform features. So it features intuitive web and mobile interface, quick onboarding using PAN, Aadhaar bank and DMAT details, filters for credit rating, tenure and yield, and limited product list. Only 21 bonds are currently available and there are no active FDs available. But even a sleek interface has limitations. Can filters reveal underlying credit risk? Are you mistaking convenience for safety? Is the simplicity of presentation masking complex risk structures? Let's be clear. Convenience should enhance, not replace investor caution. So Giraffe says no matter where you stand on the pyramid, there's a bond for you. Yet a closer look at current offering shows that most fall into high yield, high risk categories likely suitable for only for aggressive investors. Another tagline reads, "Bulls fight, bears panic, giraffe rises above." While poetic, this suggests that bonds are safer than equities during volatility. But in truth, equities, despite volatility, often offer inflation beating long term returns. Bonds, especially high yield ones, carry default risk that cannot be ignored. So don't let clever branding cloud your judgment. High yield often comes with higher risk. Then who should consider Giraffe? Investors comfortable taking on credit risk within debt instruments, aggressive savers aiming for higher returns than traditional options, individuals with small experimental capital looking to diversify. But before diving in, ask yourself, can I handle the possibility of losing money if a borrower defaults? Am I ready to stay invested until maturity, even if I can't easily access my funds? What happens if the platform shuts down? How will I retrieve my investments? Does this choice align with my long term financial goals? Giraffe is best suited for experienced investors who have already secured their essential financial foundations and are now seeking thoughtful diversification. So, let us take a look into the tax implications. So, listed bonds, if it is held for 12 months or less, short-term capital gains tax or tax at your income tax slab rate, and if it's held for more than 12 months, long-term capital gains tax is taxed at 12.5% without indexation. And for unlisted bonds, if it is held for 24 months or less, STCG is taxed as per your income tax slab, and if it's held for more than 24 months, LTCG is taxed at 12.5% without indexation. And for interest income, which is for both listed and unlisted bonds, it is subject to tax deducted at source at 10%. And for fixed deposits, TDS applies only if the interest income exceeds 50,000 rupees and 1 lakh for senior citizens. So you can submit form 15G or 15H to avoid TDS if your income is below the taxable threshold. So let's take a deeper look at risk. So if you take a look at equities, especially mutual funds, it can be volatile. We have all seen markets swinging wildly, sometimes falling 40 to 50% during a crash. But here's the thing. Equity funds don't default and will not become zero. You don't lose your capital unless you choose to exit at the wrong time. Historically, markets have recovered. Patient investors often come out stronger on the other side. Now, contrast that with bonds. What happens if the bond issuer fails to pay interest or return your capital at maturity? That's not just volatility, that's a default, and it can mean permanent loss. And we have seen this happen before. DHFL 2019, over 1500 crore defaulted both interest and principal. ILNFS 2018, a massive 91,000 crore default that shook the financial system. Yes Bank 81 bonds, retail investors lost everything, 100% write-off. So, are bonds less risky just because they are not stocks? Not quite. Even senior secured bonds carry credit risk. While they are typically backed by collateral, it's not a guarantee against loss. What if the collateral drops in value? What if recovery takes years or doesn't happen at all? Meanwhile, equity mutual funds bring other strengths to the table, like diversification, liquidity, and professional management. And over the long term period, their risk adjusted returns, especially from large cap or hybrid funds, can be surprisingly strong. In a nutshell, bonds may feel safe because they are stable on the surface, but they carry their own kind of risk, just in a different form. So instead of asking which one is safer, maybe ask, can I handle the ups and downs of equity? Am I prepared for illiquidity or a default in bonds? Does my portfolio balance growth with safety? There's no one size fits all answer. The key is to match your investments to your temperament, time horizon, and financial goals. Because at the end of the day, smart investing isn't about picking sides, it's about knowing your risk and owning it. So let's rewind to April 2020. Franklin Templeton, one of India's most trusted fund houses, abruptly shut down 6 debt mutual funds. Just like that, over 25,000 crores of investor money were frozen. And here's the twist, these weren't underperforming funds. They had consistently outperformed fixed deposits for years. For many investors, it felt like the perfect balance of returns and stability, until they weren't. The pandemic triggered panic redemptions. The bond market froze. There were no buyers for the low rated, illiquid bonds Franklin had loaded up on. Suddenly, investors were locked out of their own money for months. The funds hadn't failed on paper, but the structure collapsed under stress. Eventually, most investors got their capital back. But the lesson was loud and clear. Strong past performance isn't protection against a weak portfolio underneath. History doesn't repeat, but it often rhymes. Now, pause for a second. If a reputed AMC like Franklin Templeton, with seasoned fund managers, SEBI oversight, and daily NAV disclosures, could end up freezing investor money, what about platforms offering unlisted bonds from lesser known issuers? There is no regulatory NAV, no secondary market liquidity, no guarantee of principal, and no historical data that's been tested in a true credit crisis. We are not saying Giraffe or similar platforms or scams. Far from it. But ask yourself, do you really know what's backing that 9.5% fixed return? What if the underlying NBFC hits a cash crunch? Who steps in to protect you then? Even Franklin's investors had to wait months. Here, the risks are higher and the safety net thinner. So, what are the important takeaways? Platforms like Giraffe earn through markups, not transparent fees. So, always double check the final yield you're being offered. Even though it is SEBI registered, it's not as stringently regulated as mutual funds. Recovery of funds in case of default can be long and complicated. Think years, not months. The bond market is illiquid, so if you need to exit midway, finding buyers is not guaranteed. And there are smarter alternatives. So instead of locking your capital in opaque high yield products, consider SEBI regulated credit risk mutual funds that offer built in diversification, reducing the impact of a single default, daily NAVs, and transparency so you can track performance and risk in real time, professional risk management by seasoned fund managers, and liquidity and exit options unlike private unlisted bonds. Do you want safer debt with zero fees? Then check out RBI's retail direct platform. It lets you invest directly in government securities, offering solid safety with sovereign backing. So what is the final takeaway from this video? Platforms like Giraffe open new channels for accessing fixed income investments, but beneath the slick tech lies significant credit and liquidity risk. So before investing, understand what happens if the issuer defaults, know whether you can absorb the loss or handle a lack of liquidity. Ask yourself if you're comfortable stepping beyond AAA rated safety nets. If you're uncertain, rethink your allocation. A certified financial planner can help you to construct a prudent debt portfolio tailored to your goals. Balance risk and return intelligently, not emotionally. Align your investments with your life goals, not marketing hype. So don't risk long-term peace of mind for a few extra points of return. Choose options where risks are known, exits are open, and professionals have skin in the game. Do you want a debt strategy that actually works for your life goals? Then don't let marketing hype or high yield promises steer you off course. There's a link in the description below to schedule a free consultation with a certified financial planner. So do register so you can design a portfolio that balances growth, safety, and peace of mind tailored just for you. So stay smart, stay invested, and stay rest free. And if you find this video valuable, give it a like, share, and subscribe to our YouTube channel. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.